Welcome everyone. I want to congratulate you all for being here tonight. By staying informed, you will be able to design a retirement plan that will last as long as you do. This is a Roth IRA, Roth Alternative webinar. Just some housekeeping to do here. If you can see my screen and hear me, please uh, put yes in the chat box. You can see my screen and hear me, please place yes in the chat box. Okay, good. Thank you. I have a business proposition for you tonight. Um, let's say we're going to be partners and you are going to do all the work. If the business struggles, I'm not going to offer you any help whatsoever. Whenever you sell, I get 1/3 guaranteed. If you sell too early, I will charge you a 10% penalty on top of my guaranteed 1/3. If you want to sell later than I want to, then I can force you to sell. How many of you would go into business with me? Place those comments in the chat for me. How many of you would go into business with me? Place that in the chat box. Okay, I'm not getting any takers whatsoever. What I just described to you is a traditional IRA or traditional 401k. How many of you have a traditional IRA or 401k? When it comes to your IRA and 401k, who earns the money? You do. When the stock market goes down, your IRA and your 401k loses money. When it's time to start taking retirement income, who takes 1/3 of your withdrawals in taxes? Uncle Sam. If you take money out before 59 and a half, there's a 10% penalty. After age 72, you must take RMDs or face a 50% penalty. Tonight, we're going to educate you by providing tax planning strategies that could be a huge benefit for not only you, but also your family for decades to come. There are two systems of taxation in the good old USA, one for the informed and one for the uninformed. And I want to congratulate you again for being a member of the informed group. What we're going to learn tonight is we're going to learn strategies that will solve the tax problem with traditional retirement accounts, how to create tax-free income with a Roth IRA and avoid the RMDs at 72, an alternative to the Roth IRA, and then a strategy that solves the stock market risk problem so you can make sure that your money lasts as long as you do. My name is Michael Owens. I'm the president of Carolina Financial Services Group. I've been an advisor for over 30 years, so I have been around the block several times. My team and I are retirement income specialists. We help pre-retirees and retirees design a plan so that they can sleep well at night. Our risk reduction strategies will either reduce, transfer, or eliminate the major risk of your retirement. These strategies provide clarity, security, and certainty for our clients. Here's my contact information. You can take a screenshot of that. Also, this will pop back up as we get closer to the end of the workshop. Got my phone number, my calendar link, email address, and also a link to our company website. Now, what motivated me to become an advisor in the first place? Well, it's personal for me. My motivation comes from both of my grandparents needing stay-at-home care for the last few years of their lives. My grandmother's name was Annie. She was a teacher and principal. My grandfather's name was Mark. He was a farmer. They were both smart. They worked hard and they saved. However, working hard, being smart, and being successful may not be enough if you do not prepare for the major risk of retirement. My grandfather was diagnosed with Parkinson's. This took control of his lifestyle. And when you lose control of your lifestyle, for whatever reason it is very difficult to regain. He died at the age of 79. My grandmother, at the age of 93, she needed stay at home care. Her stay at home care cost $36,000 a year. That was almost 30 years ago. Today's cost of stay at home care starts at $55,000 a year. Now, how much do you think this care will cost in 10 to 15 years? Place your comments in the chat box for me. How much do you think this care will cost in 10 to 15 years? Have you prepared for this type of risk for your retirement? This is a live private event. And in order to get the most out of the workshop, what I would ask you to do is stay focused, silence your phone, exit out all the other tabs you may be on. If you're in a room where you can close the door, close the door. Give yourself the next 45 minutes to become more informed about your retirement options. You can ask me questions in the chat. I'm going to wait until the very end to answer those questions. The workshop will probably answer most of those, but I will take some time at the end to answer questions. Do me one more favor. Grab a pen and a pad to take notes. This is very important to do because it allows you, after the workshop tonight, it allows you to go back and read over those notes and refresh what we've talked about tonight. During tonight's workshop, from time to time, I will suggest that you write down some information. So if you don't already have the pen and pad handy, go ahead and grab those real quick. There are 3 stages of retirement. The first is accumulation phase. That's when you're working, you're paid a paycheck, and you're growing your nest egg as much as you can. The second stage is that transition stage, which is one of the most dangerous stages there is. It's 5 years before, 5 years after you've retired. The distribution phase is the final stage. That is the phase where you retire and you start taking income off of your retirement nest egg. So to put it in a nutshell, you grow your nest egg as much as possible, and then you start taking income from it when you retire. Now, there is one area that perhaps you have not considered, and that is taxes. Taxes, just like the growth and the income, can be a critical component of ensuring that you have enough retirement income to live on. So let's take a look at this. Got a 64-year-old, 25% tax bracket, $500,000 IRA, and a 5% annual growth. Now, I want to warn you, for those of you that have weak stomachs, for the next slide, what you're going to see will make you sick to your stomach. So I want you to prepare for it. So we've got $500,000 IRA, 50% in the stock market, 50% in the so-called safe investments. So it's a 50-50 portfolio. from 72 to age 90, that's when you receive the RMDs, from 72 to age 90. Total taxes paid on that is $204,000. Now, if you reinvest the RMD money, taxes on the growth of the RMD is $96,000. And then if you happen to be in a situation where the taxes have to be paid by your heirs at your death, there could be another $156,000. So the total taxes paid off of a $500,000 IRA or 401k account is $456,000. Write that down. With a $500,000 IRA, you could potentially pay up to $456,000 from age 72 to age 90. Now, write this down. How are you going to avoid this problem? We'll come back to this in just a little bit. Now, we do have a special offer tonight. If you stay with me till the end, you will be eligible to receive the offer. I'm going to go ahead and show that to you. Okay, so you should see that slide out. This offer may be for you if you're concerned about paying taxes during retirement. Some people aren't. Some people say, you know, I'll worry about that later. We'll figure it out after I've retired. If you want to determine if you're a good candidate for a Roth IRA or a TFRA. Now, what we have found is that many people who attend our workshops, and we have people all across the country that attend these workshops, they're looking for a better retirement outcome than what they currently have. This offer could save you thousands of dollars. So take advantage of it. Now, once you hit the green button, this will pop up. It looks just like this. That's the first page of my calendar. The blue dots are each day, and you pick on a day that works best for you. And we'll go back through this in just a few minutes. Now, one of the common focus points for retirement planning is how are you going to be taxed in retirement? See, when you get into retirement, most people no longer have mortgage deductions, dependents, or contributions. Therefore, you could possibly stay in your current tax bracket or even go to a higher bracket. You see, at retirement, when you pull your money out, that exposes it to taxes. Now, tonight, we're going to share with you how to make your retirement income as tax efficient as possible. How can we reduce the exposure of our money to taxes? So, solving for taxes. See, the problem is that traditional IRA and 401k account holders, they pay taxes in retirement on the harvest. And that's the most expensive part because you're paying taxes on the largest amount. And this makes the government the primary winner. So what's the solution? Well, in order to create the best retirement income possible, we must find a tax-free solution. You see, the key to tax planning is to reduce the tax exposure on your money. Write that down. The key to tax planning is to reduce the tax exposure on your money. With a traditional IRA and traditional 401k accounts, you have a partner. That partner is the IRS, or Uncle Sam. Uncle Sam is a silent partner during the accumulation stage of your retirement, and they place a lien on your retirement accounts. At the age of 72, the IRS requires that you start taking an RMD, required minimum distribution. You see, the RMD exposes your retirement money to taxes. The IRS is going to take up to a third of your retirement income. So what we should be doing is proactive tax planning rather than reacting to the taxes. Most people meet with their CPA from January 1st to April the 15th. There's not a lot you can do to fix a tax problem after the fact. Write that down. Most people meet with their CPA from January 1st to April 15th. There's not a lot you can do to fix a tax problem after the fact. It is easier to prevent the tax problem. An ounce of prevention is worth a pound of the cure. So how do we solve this? There's three buckets. Okay, the first bucket, the one that's in the red, is the tax me now bucket. That's when the IRS taxes that money every single year. The middle bucket, the orange one, is the tax deferred bucket or tax me later bucket. It defers the tax, but it's still a ticking tax bomb. You see, another word for deferring is procrastination. When have you ever known that procrastination makes a problem go away? In fact, what it does is it makes it even worse. The tax-free bucket, you could also call it the don't ever tax me again bucket. It's the green bucket. This has to do with tax-free money. So to summarize the three buckets, you've got the tax me now bucket, you got the tax me later bucket, and you've got the don't ever tax me again bucket. Now, write this down. TFRA stands for tax-free retirement account. Tax-free retirement account. In a tax-free bucket, all the money goes directly into your pocket and into your lifestyle. Write that down. In the tax-free bucket, all the money goes directly into your pocket, into your lifestyle. So where do you think taxes will go in the next 10 to 15 years? In the 1950s and early 60s, the U.S. income tax rate was 90%. For every dollar you made, you paid the IRS 90 cents on the dollar. Now, can you imagine having to pay these taxes today or in the future? Here's the thing, we have no control over the tax rates. However, we can control how much money we have in taxable accounts. And the real question is, how much tax exposure do you want? Place your answer in the chat box. How much tax exposure do you want? Okay, I'm getting a lot of 100% without any tax exposure. So we've got some other ones coming in too. Yeah, here's another one. I like that, Mary. A lot less than I have now. The federal debt is at $32 trillion. $32 trillion. The total national debt is over 195 trillion. The Social Security liability is 22 trillion. The Medicare liability is $34 trillion. So what does that mean for taxes? Higher debt, higher taxes. You see, the government's going to raise taxes to offset their spending. They can raise the tax brackets, but also they can actually reduce or eliminate deductions. Okay. And I'm sure most of you are very familiar with this quote. Nobody making under $400,000 will have their taxes raised, period. Okay. How many of you believe this? Place your answer in the chat box. Nobody making under $400,000 will have their taxes raised, period. Place your answer in the chat box. Now, if you say yes, if you do, I have a bridge in the middle of nowhere where I'd like for you to buy it from me. I'll sell it to you. Okay. Now, we've heard President Biden and his staff state this several times. I personally do not believe that this is true. I don't think his statements take into account all the ways the taxes can increase on the average American. I just don't believe it. Now, if you would like an estimate of how much you could be paying in taxes during retirement, take advantage of our offer. We will help you determine how much taxes you will pay. We'll help you determine if you're a good Roth candidate. We'll help you determine if you can qualify for the tax-free retirement account. We will review your accounts to determine what is at risk and what is stable and secure. So what is a Roth IRA? It is an individual retirement account. It is designed to help supplement income. It's designated for retirement. We're going to see the differences between the traditional IRA and the Roth, and we'll also look at the Roth contributions as well. If you want to create tax-free income and avoid the RMD at 72, then take advantage of our offer. People have saved hundreds of thousands of dollars by properly using either a Roth IRA or a tax-free retirement account. So what's the difference between the two? With a traditional IRA, you are taxed on the harvest, which is the larger amount. Write that down. With a traditional IRA or 401k, you are taxed on the harvest, which is the larger amount. The traditional IRA has an RMD requirement that starts at 72. It doesn't matter whether you want the money or if you don't need the money. The IRS forces you to make those distributions starting at age 72. Withdrawals are taxed as ordinary income. With a Roth, we choose to pay taxes on the seed, which is the smaller amount. Write that down. With a Roth IRA, we choose to pay taxes on the seed, which is the smaller amount. And on this particular slide, you can take a screenshot as well. There's no RMD for the Roth, and withdrawals are tax-free. The traditional IRA is a ticking tax bomb. With the Roth, all the money goes into your pocket and into your lifestyle. We've got a question. If you're not going to pay the taxes out of your pocket when you start taking income out of your retirement accounts, how much would you need to withdraw from your traditional 401k or IRA to net $100,000? If you're not going to pay for the taxes out of your own pocket, out of non-retirement accounts, how much would you need to withdraw from the traditional 401k or IRA in order to net $100,000? Place your answer in the chat box. Okay, give me some answers. What would you have to withdraw to net $100,000? Okay, I've got one person that said 150,000. The actual answer is $137,000 because roughly 1/3 will go to pay taxes. So let me put it to you a different way. All right, here, hope you can see that, is your IRA 401k. When you withdraw money, the IRS gets 1/3, and then they spend every single penny of it. Every single penny. With the Roth IRA, if you're a married couple and you make over $214,000 in income, you are no longer eligible to make a Roth contribution. So what's the secret sauce? I mean, what do we do to maximize the Roth IRA? It is called the Roth conversion. Write that down. The secret to maximizing a Roth IRA is the Roth conversion. Okay. There are limits on the contributions, but there are no limits on the conversion. You don't have to have earned income. There are no income or age limitations. You are allowed to convert as little or as much as you like. Write that down. You are allowed to convert as little or as much as you like. Sounds pretty good so far. I had a client, Joe, he had IRA accounts at 10 different banks. Every year he would go to each bank and he'd find out what the RMD was for that year. Well, one year Joe forgot and missed one of the banks, so he didn't take the RMD. He paid a 50% penalty for not taking the RMD before December 31st of that year. Now, Joe could have avoided that penalty if he would have converted his traditional IRAs to Roth IRAs. We are currently at some of the lowest rates that we've had in modern history, but that might begin to change here soon. And what I mean by that is, at the end of 2025, the Trump tax rates will automatically go back to the higher tax rates under Obama. So if you want to make your retirement accounts to be more tax efficient, you have 3 years before the taxes automatically go back up. 3 years. Now, how many of you think that Congress will make the lower tax rates permanent before the end of 2025? Place your thoughts in the chat box. How many of you think that Congress will make the lower tax rates permanent before the end of 2025? Okay, I'm getting some no ways. I got a hell no. So, okay. With the Roth conversion, you pay taxes on the seed, which is the smaller amount, or the crop, which is the larger amount. See, the goal is to keep the government out of your business and out of your pocket. This is why it would be very beneficial to take us up on our offer. Our analysis will help you determine if you're a good candidate for a Roth conversion. And not everyone is a good candidate. So which would you do? Would you rather pay taxes on the seed, which is the smaller amount, or pay taxes on the larger amount? Now, what if tax rates are not higher in 5 to 10 years? Worst case scenario is you're in a 0% tax rate for as long as you live, and you do not have to worry about RMDs. So on a scale of 1 to 10, how concerned are you about paying taxes, higher taxes, during your retirement? Place your comments in the chat box. Now, you've heard me say required minimum distribution a couple of times tonight. So this is what it is. At age 72, the IRS, Uncle Sam's going to require that you start taking money out of your taxable 401ks, IRAs. And when you do that, you're creating taxable income. When you take money out, you're exposing it to taxes. Now, regardless of whether we need the money or not, the IRS is going to come knocking at your retirement door at the age of 72. What makes it even worse is you're forced to take more and more money out over time. The RMDs could actually bump you up into a higher tax bracket. The RMDs could cause you to pay more for your Medicare Part B premiums. Not having a tax plan can have major effects on your retirement assets, all of your retirement assets. Taxation is one of the biggest risks to your retirement. Now, if you would like to find out how to reduce your tax burden during retirement, take advantage of our offer. So the government wants you to save for retirement. However, they still want their cut. And the RMD is a way to ensure that they're going to get their cut. At age 72, you're forced to take the required minimum distribution. Now, if you miss the RMD, like I alluded to before, there is a 50% penalty. Write that down. There is a 50% penalty if you do not withdraw your RMD. 50% penalty. So here's an example, and this goes back to my client Joe. Again, he forgot to take his RMD 1 year. So in this case, there's a $20,000 RMD that was missed. So right off the top, $5,000 for the income tax, $10,000 for the penalty. So it's a total of $15,000 to the IRS. Not so good for Joe, but good for the IRS. Now, can you imagine going home and telling your spouse, I am so sorry, I've made a huge mistake with our RMDs. We owe the IRS $15,000. Now, my wife would say, what do you mean we owe the IRS? Think about how you would feel if this happened to you. If you would like more details on how to avoid mistakes like this, take advantage of our offer. Now, before we move forward, I guess you could say this seems to be relatively easy. It is not. Doing this wrong can do several things. One, it can increase your healthcare cost. It can increase your taxation, and it can increase your capital gain taxation. Now, during retirement, it is very important for you to make wise decisions and to avoid big mistakes. For many people, their retirement money is the most money that they have ever had. Most understand that this is not a do-it-yourself project. They don't want to do it alone. TFRA, the Roth Alternative. With the Roth Alternative, there's no stock market risk. There's virtually no limits as to what you can put into it. And it does come out, the income comes out tax-free. TFRA stands for tax-free retirement account. With this strategy, as is the case with the Roth conversion, you pay the taxes up front and you are done with Uncle Sam. With a tax-free retirement account, you never pay taxes on the growth. You can deposit as much as you want. The income is not reported, and your money is liquid. Now, some might say this is too good to be true. However, you don't know what you don't know. This is real. In fact, the TFRA is not a new investment strategy. Accounts like these have been used by wealthy individuals and families for over 100 years. Again, you don't know what you don't know. So let's go back to the example that I gave you earlier on. Your RMDs are paid from age 72 to 90. The taxes on the RMDs is $204,000. If you reinvest the RMDs, the taxes could be another $96,000. And then there could be some taxes that are owed by your heirs at your death. So a potential $156,000 for that. You know what this is called? It's called highway robbery. Do you like being robbed? If you say no, how are you going to prevent from being robbed? Whose retirement account is it? Is it yours or is it Uncle Sam's? Who gets the most benefit out of it? You or Uncle Sam? Now, not all is lost. Again, we can go back and look at a Roth conversion and also the TFRA. So in this case, $500,000, we do a conversion to either the Roth or the tax-free retirement account. We end up paying $125,000. Taxes paid on the growth, there is none. Taxes paid on the remaining value at death, there's no tax there. So when you pay $125,000, you are done with the IRS. And now your tax bracket is 0. How's that sound? Here's another way to put it. You're on your retirement journey and you're coming up to your retirement. Which exit are you going to take? Are you going to take exit $450,000 where the IRS will continue to be your partner until the day that you die? Starting at age 72, Uncle Sam will take up to a third of your RMD withdrawals every single year for the rest of your life. So that's exit 450,000. If you take exit 125,000, this is where you disinherit the IRS as your partner by paying taxes on the seed. So for $125,000, you can buy out the IRS's ownership of your account, and you never have to pay taxes again. Which exit would you prefer? Place that in the chat box. Which exit would you prefer? As part of our analysis, we will provide a comparison between your tax-deferred retirement accounts versus your Roth IRA or the TFRA. Again, is this your retirement account or is this Uncle Sam's retirement account? Who benefits the most? Something that we're doing tonight as a bonus, I've already posted this in the chat box one time tonight, but I'm gonna go ahead and do it now. And okay, that should be at the top there now. So you may have to end up copying and pasting this into a browser. But what this is, it's actually a retirement tax bill calculator. And within 30 seconds, it will give you an estimate of the potential taxes that you may have to pay during retirement. Okay, there you go. Here's another feature that I want to make sure that you understand this, and it's a really popular feature for clients that have decided that this is a good solution for them. With the tax-free retirement account, it has what the feature is called an annual lock-in or an annual reset. And in this example here, you see $100,000, the market goes up 10%, and the TFR account goes up 10%. You see the TFR is linked to, you can link it to different stock market indices. Your money's not in the market, but it will mirror whatever stock market indices you want to link it to. So in this case, the S&P went up 10%, your tax-free retirement account went up 10%. In the second year, the stock market dropped 10%. The TFRA did not. It has a 1% floor. Now, most of them have 0%, but there are a couple that have a 1 to 2% floor. So that would guarantee you to make either 1 or 2%, even in the years when the market is down. But again, most offer you the 0% floor. So in the second year, the TFRA actually went up just a tad by 1%. It did not go down 10% like the market did. In the third year, market goes up 5%, the TFR goes up 5%. So the end of the 3-year period, there's a $12,000 difference between the TFRA and the stock market account. You see, with a TFRA, there's no stock market risk. It locks in gains each year, and it locks out losses each year. And don't forget, the money comes out tax-free. This is a longer term time frame for this, just so you can see how it works longer term. This is the 20-year period. These are the returns for the S&P 500 for the last 20 years, the actual returns. Okay. So in the first 3 years, does anyone remember 2000, 2001, 2002? The stock market went down for 3 years in a row, and it felt like it would never stop going down. The tax-free retirement account, having that 0% floor, did not go down at all during those 3 years. Remember, it locks in gains and it locks out losses. If you go to 2008, and this is a big difference here. In 2008, the S&P 500 was down 40%, and I'm sure most of you remember that. 2008, the stock market was down 40%. A lot of people were down more than that. The TFR account showed a 0% return. Write this down. 0 is your hero. 0 is your hero. Would you have rather had the 40% decline in the market or the 0% with the tax-free retirement account? Now, in 2008, let's just say that you're a young, spry 53-year-old, 2008. You can absorb the stock market loss because you're working and you're getting a paycheck and you don't need the income off of your nest egg. You still may have 5, 15 years before retirement. Now, fast forward to today. You're now 67 years old. You are retired. You no longer get a paycheck. You do need income from your retirement nest egg. During retirement, time is no longer your friend. You do not have the luxury of waiting for the stock market to recover. Please write that down. During retirement, time is no longer your friend. You do not have the luxury of waiting for the stock market to recover, particularly since you're taking money out of those accounts. So let's take a look and kind of compare the two. These are the features here on the left-hand side. TFRAs is the first one. Roth plans are the second. You can see that the TFRA has multiple benefits. The two major benefits of the Roth is one, no RMDs, and two, the money comes out tax-free. So that's two benefits for the Roth. For the TFRA, there's no stock market risk. It locks in gains and locks out losses. There are no RMDs, and the money comes out tax-free. So the TFRA offers income that is tax-free, growth without stock market risk. It locks in gains and locks out losses each year. There's a guarantee of principal, and there is no RMD requirement. Now, some of you may be thinking, this guy's nuts. This is too good to be true. Well, take a look at this. These are famous entrepreneurs that have relied on this strategy. The founder of McDonald's, the founder of Disneyland, the founder of JCPenney's. Were these people nuts? What about the big banks? What do they do? One of the largest banks in the U.S. at the particular time of this report had $23 billion in this strategy. $23 billion. So if it's good for them, why not you too? We're going to take a look at two other risks tonight, just very briefly, because we want to try to keep things relevant. And these two things are on the minds of most people today. There is another tax, and it's called a different name, and it's called inflation. So food prices at the grocery store have gone through the roof. Since January 2020, at one time, gas was up 92%. Just like taxes, inflation takes money out of your pocket. I read an article yesterday that said that the UK expects their inflation rate to go up to 18.5% early next year. 18.5%. Right now, we're at 8.5 to 9. Now, we can't trust a whole lot of what comes out of China, but there are sources that say that the inflation in China is soaring and that the Chinese economy is about to collapse. That's not good for the rest of the world. So what does inflation do? Well, it causes you to lose purchasing power. It decreases your purchasing power because prices are rising so dramatically. So in this example, 100,000 in 10 years, let's say we average 8%. And I hope that never happens. So let's just say we average 8% over a 10-year period. That means that your $100,000 now is worth $46,000. The other big risk that's in today's headlines, it seems like this whole year, and the theme this year about the stock market has been volatility. I mean, it's been a roller coaster ride. We've seen a nice bounce since July. However, this may be the eye of the storm, and we may not have seen the second half of this storm. So the problem is with traditional IRAs, 401ks, usually they're exposed to the stock market, and the downturns can be detrimental to your retirement income, and it can be very difficult to recover from those losses. So the solution is we need to either eliminate or reduce exposure to stock market declines. Now, another question is, are we going to go into a recession? Will the stock market continue to go down if we go into a recession? I just saw this today or yesterday. Ford just announced yesterday that it's laying off 3,000 people. Microsoft is laying off 1,700 people. These companies are preparing for the second half of the storm. What are you doing to prepare for this storm? Do you have 7 years during your retirement to wait for the market to recover from a major downturn? If you do feel this way, take advantage of our offer. So the problem with the status quo is this. It's very easy to stay with the status quo. It takes a whole lot less energy, a whole lot less effort. But ignoring and not planning for these risks can devastate your retirement. On a scale of 1 to 10, how committed are you to reducing your tax exposure during retirement? Place that in the chat box for me. If you're not concerned, or if you are concerned about not having enough money to retire on, or you're worried about running out of money during retirement, you should take advantage of our offer. So I want to congratulate you. We are at the end of the webinar. Our special offer is this. We'll help you determine how much taxes you'll pay during retirement and what to do about it. We'll help you determine if you're a good candidate for the Roth conversion or for if you qualify for the tax-free retirement account. We will review your accounts to determine what is at risk and what is stable and secure. Now, the total cost of this would normally be $1,200, and it is worth every penny of that. This is the best money you would ever spend, and it could help you put thousands of dollars back into your pocket and into your lifestyle. Now, I'm happy to share with you that we're going to make this complimentary if you sign up for the offer tonight. This is our way of thanking you for taking time out to attend the webinar. Now, to make the most of the call, please have your statements for your 401ks and your IRAs, or if you got a TSP, 403B, 457, whatever it is, please have those out during the call. And many people will go ahead and share those statements with us prior to the call. Those people want to get a step ahead. So if you're married, we highly recommend that both spouses be on the call. Even if one spouse makes the investment decisions, the other spouse needs to stay informed. And the best way to do that is to hear the information from the horse's mouth. Now, we had a call with a 75-year-old lady last week. Her husband died about a year ago. The husband had managed the investments for 50 years. She said she'd never had any real interest in it. Her husband did, and so he handled it. Now this lady does not have a clue what to do. A clue what to do. Don't leave your spouse clueless. Have them attend the call with you. Now this is my contact info. Again, you can take a screenshot of this. If I don't get to your question tonight, feel free to email us. We'll certainly do our best to answer those questions. If you have trouble tonight scheduling a call on the calendar, please contact us. Just don't ignore it. Contact us, and we'll help you find a day and a time that will work best for you. Again, we're doing something different tonight. We're adding a bonus, and again, that bonus is the retirement tax calculator. I've already placed that into the link into the chat box 2 times now. You may have to copy and paste it into your browser in case the link doesn't work from the chat box. So again, that's my contact info there. Okay, now once you click on the green button, I'll bring that back on in just a minute. The first page will pop up. It'll look just like this. This is my calendar. The blue dots, or a blue dot is for each day. You pick a day that works best for you. If you can't find a day on the calendar, contact us and we'll make sure we can work something out with you. All right, once you have picked a day, the next page will look just like this. On the right side, it'll have the time slots. You pick a time that works best for you. And then the last page, that is where you place your information, your name, your email, phone number. And please, this is another important thing to do. Please share with us why you would like to take advantage of the offer. This will help us determine what you want to talk about during our call. And don't forget to hit the schedule event button. And you should see that slide out. Is that not already on there? It should pop up now. So again, don't forget to schedule the event button. I'm going to wrap things up by asking you if you could have no losses in retirement and at the same time either reduce or eliminate taxes, do you think this would provide more security and more certainty for your retirement? Place that in the chat. Um, if you could have no losses during retirement and at the same time reduce or eliminate taxes, do you think this will provide more security and certainty for your retirement? Type that in the chat for me. Taxation is one of the major risks to your retirement. Don't procrastinate. Don't stick your head in the sand. If you want a better retirement outcome, you must take action and plan for it. Our analysis will provide clarity, certainty, and security for your retirement. I hope that we have answered most of your questions. I'll look to see if there are any questions now in the chat box. Have a good night and take care. All right, let's see. Yeah, there's a couple of questions in here about how do we know that the Roth will not change down the road. We don't know. Nobody's got a crystal ball, so there's no way to know that. In those cases in the past, usually what happens is that gets grandfathered in. So for people that are already in it, they will be grandfathered in, but there's no way of knowing that. You have to make the best decisions in the environment that you're currently in now. Yes, there's another thing in here about the IRMA, which has to do if you make too much money, then they raise the cost of your Medicare Part D premiums. They actually do a 2-year look back, so that's what Tom is referring to here. Okay. Another question is too, why am I saying 1/3? That's just an estimate of what the taxes will be. Everybody's tax situation is different. If you're in the tax bracket of, let's just say you're in a 22% tax bracket, that's the federal. And what if you're in a state that also has a 6% state tax? So now you're at 28%, which is close to 30%. So that's just what we use. We will determine that on a case-by-case situation. Okay. I think that's just about going to wrap this up. Okay, this was an answer to a question that I asked earlier about. I think this was in reference to, do you think that that Congress is going to make the lower tax brackets permanent before 2025? And this person said, I do not believe this, which I think most people would have the same answer. All right. Okay. Just let me scroll through here. I want to try to get to as many of these as possible before we end it for tonight. Okay. Yeah, there's some questions about what the returns are. These are just concepts and strategies that we talk about. So there's really not any information at this point that I would say as far as your yearly returns go. Um, I would answer that in this fashion, and that is, if you could make 4 to 7% a year, knowing that you could not lose, would that be a strategy that you would consider? If you can make 4 to 7% a year and you knew you could not lose, would that be a strategy that you would consider? Okay, well, that is going to be it for me. I'm going to call it a night. Again, if we didn't get to your question, please email me. I'll go ahead and place my email address in the chat box. Oops. All right. There we go. So there is my email address. If you feel like you want to take advantage of the offer and you're going to schedule a call with us, I would urge you to go ahead and do so. These webinars are very popular, and after these webinars, our calendars get rather full. So if you feel like you do want to have one of those, I would encourage you to go ahead and schedule the call. If you can't find any dates and time that work for you, just email us. We'll work something out with you. So we'll try to make it convenient for you on a day and a time that works best for you. And last but not least, again, this is something new that we're just doing as a bonus. This is the link to a retirement tax bill calculator. You plug in your age, the value of your traditional IRA or 401k, type in your name, email, phone number, and that takes about, and also provide the average tax rate. It doesn't have to be perfect. The default is at 25%. But it takes you 30 seconds to fill this information in. You click see my bill, and it pops up right in front of you. Couldn't be any easier to do. And on top of that, you'll get an email with a report in it that shows you what your potential tax bill could be. So that is in the box. You may have to copy and paste it into the browser. I don't know if that link will work out of the chat box or not. Yes, there is a recording of the video. So within the next 24 hours or so, you should get an email with a link that takes you to the recorded webinar. That's going to be it for me tonight. Again, have a good night and take care.